The S&P 500, why is it so difficult to beat? It's something you can see just there on the screen. Well, the key reason is it's actually, at the moment, certainly a portfolio of just 7 stocks. The Mag 7. Why? Because it's capitalization weighted. In other words, the bigger the company, bigger the market capitalization of the company, in other words, then the bigger the weighting it has on the S&P 500. And essentially, at the moment, 7 companies have a bigger weighting than pretty much all the other 493 put together. Interestingly enough, the 7 with the highest weighting, which track and move the S&P 500 the most, are also the ones which are probably the least overvalued and some would argue undervalued compared to the other 493. So the 7 moving the S&P 500, which are actually the ones that matter for the index. But would you have a portfolio that concentrated? Of course not. And that's why you're not going to beat the S&P 500. And certainly fund managers wouldn't have one that concentrated because it would be a job loser. So they have another reason not to concentrate that much, which is why it's so difficult, amongst many other reasons, for them to beat the S&P 500. And for you as well for that reason. So what's the answer? Well, probably increase your concentration to maybe, look, let's get to 20 equities if it is suitable to you. Not financial advice, of course, because I don't know your personal circumstances, but an extra degree of concentration, the likes of which a Buffett or a Gates has. And you might say, wait a minute, they've got, in their first 5 holdings, they've got the majority of their money. That is absolutely correct, but they're billionaires. You shouldn't. You should have it sprayed and prayed across the board. Well, you've seen what that does. That leads to pretty poor performance. How do I know that, and how do you know it? Because you look at your pension and what St. James's Place or a Bruin Dolphin or an IFA has done to it, and they've done the spray and pray approach because they say to you, no, you don't have the wherewithal to stomach a more concentrated portfolio, and you don't get the growth. The low volatility, well, gee, thanks for that. It's actually a waste of time, and they've just managed to take 1% of your fees. And here's what's even worse. They're targeting 5% per annum. They take 1% of your fees. That's 20% of your profits they're taking. We in the hedge fund industry take 20% of profits, but we do it from massive institutions, not retail clients. We can't even take retail clients as clients. So in effect, the IFAs and wealth managers have set themselves up to be like hedge funds taking 20% of your profits, but not delivering the returns. What a gig. What an amazing gig that they're on, and you're letting them do it. Just look at the simple numbers and the simple maths. Like and follow for more, and I'll teach you more about investing. Thank you very much.